watched our first episode, then you know about filing statuses. So there's 5 filing statuses. And what are those? If you didn't watch, go back and watch. But I'm going to go over it again. So the first one is single, married filing jointly, married filing separately, head of household, and qualifying widow or widower.
Look at you. That girl know her stuff.
I got it. So if you're single, your standard deduction will be $12,200. Married filing jointly, it'll be $24,400. Married filing separately, it'll be $12,200, just as if you were single. For head of household, it'll be $18,350. And then for qualifying widower or widow, it'll be $12,200, just if you were filing single. And so those things are going to deduct from your income, so it'll have less what it be taxed. So sometimes you're going to take the standard deduction if it's higher than the itemized deduction. Did we talk about itemized deduction?
No, I can go ahead and jump on that.
Let's go. Jump on
So
it.
itemized deductions are basically the expenses that you've incurred throughout the year in the area of your mortgage, interest, property tax, real estate tax, medical expenses, charitable contributions, or vehicle property tax. What else?
We covered them all.
That's it?
Yeah.
Yeah, so the whole point of the deductions is to reduce your taxable income. Okay? And so now we're going to jump into credits. What are credits? So credits are basically what reduce your tax liability. Tax liability, it just basically means that your tax bill, what you'll pay the government.
Okay.
Right? And so there are 2 different types of credits. You have non-refundable credits and then refundable credits. Non-refundable credits basically just reduce your tax liability to 0. So if you have let's say a tax bill for $1,000, and then your tax credit is $2,000, then $2,000 minus that $1,000 is what? $1,000. And so you won't be able to take that extra $1,000 because the non-refundable credit just brings it to 0. Just zeroes it out.
Okay.
And then your refundable credit is basically what?
Your refundable credit is dollar to dollar. So if you're gonna get a $2,000 refundable credit, you're getting $2,000.
All right.
Okay.
Right. So let's say if I had a $1,000, like I said earlier, $1,000 tax bill, and I have a refundable credit for $2,000. I say that man slow, but if I had a refundable credit for $2,000, $2,000 minus that $1,000 give me $1,000, but I get to take that $1,000 towards my refund. $1,000, dollar for dollar.
Dollar for dollar.
So, common types of credits are your earned income tax credit, your child tax credit, or your additional child tax credit. You got your education credits like American Opportunity, Lifetime Learning Credit. What else we got?
You covered a good amount. I'm gonna go with that.
We're just gonna focus on those. And so, with these credits, you're able to get either of these credits, they operate as a non-refundable credit or a refundable credit. For example, the earned income tax credit is a refundable credit.
And it's a good reminder if you are using one of these credits, a refundable credit, so like earned income tax credit and then the additional child tax credit, then by law the IRS cannot give you your refund until about mid-February. So just always remember that. Don't be in a rush because it's not going to get there.
Don't be making plans.
Don't be making plans on
I'm
your
gonna
money.
I'm gonna get these right here. I'm going up on Amazon.
Right.
You know?
Yeah, because I just want to make sure there's no errors or anything. Make sure that due diligence is done for those credits.
Yeah, because there's been history of
Those
tax fraud,
misused.
Yeah, so that's the reason for the delay in receiving your tax refund. All right. So bottom line, credits, deductions. Credits reduce your tax liability, and deductions reduce your taxable income. And so with that, we appreciate you tuning in. Catch us next Monday on Monday Moments with your boy Mark
And your girl Mona.